Remember, investing is not about the next 6 months or the next 12 ideally. It is a lot longer term in nature. Aditya, Birla, Sun Life AMC, the two men who need no introduction, join us on this very special show. Bala and Mahesh, Patil, gentlemen, thank you so much, both of you, for taking the time out and being with us on our launch week.
Thank you, Niraj. It's a pleasure to be part of your discussions as always. So I also take this opportunity to thank and wish you and NDTV Profit for all the contributions that you are making it for the industry, as well as for the year ahead to have the rightful impact in giving the right message to the investors across the country.
Yeah, cross fingers for that, Mahesh.
Yes, all the best to you. I think it's the beginning. I think yeah, happy to be here today.
Yeah. No, very, very happy to have you guys here. And frankly, the last, if I can argue that the last 6-7 years, the one change that both media and the mutual fund industry have done together is to ensure that Indian investors own a lot more of this Indian equity juggernaut, and not just owned only by the foreign institutional investor or majorly by the foreign institutional investor. So that's a great thing. So let's start off by, and either of you can start. How do you, what do you feel about the recency, the last 12 months, what they have meant for investors and risk assets, essentially India worldwide, and what lessons do they hold for the next 12 to 24 months?
So I'll just start, then I'll ask Mahesh to talk on broader stuff. I think one thing that has happened this year is the Indian mutual fund industry created a record. One in the form of equity assets touching a new high, and SIP book size touching new high. The number of investors who have come on board in the year 2024 is one of the highest. And while the equity the Indian investors' participation in equity was, of course, picked up immediately after the COVID during that break. But now this year has been the turn of Indian mutual fund industry. So I think 2023, if you look at till date, the significant contribution that comes from domestic investors, which has helped the equity market to remain more or less stable, calm, and continue to remain buoyant. I think I would say this has never happened in the past. This is first time it has happened. Therefore, 2023 has been a great year from an mutual fund industry point of view. And the same thing goes for the asset management industry as well. I have seen a significant growth, which all of us have witnessed. This is something is great news, which is nothing but a reflection of one, confidence, and the conviction that they have that yes, that's the way to build a portfolio. And third is the conviction on the broad economy itself. It's an endorsement of the economic buy-ins that we are saying. All these things are reflected in the way I think domestic investors, especially retail participations, have been the great news for to start with, I would say.
Most certainly. Mahesh, how would you reflect upon it?
So I think one is on the market itself, that Bala mentioned, right? The retail participation, right? We have seen a big surge in that, right? A lot of new investors coming in, and that's reflected both in the mutual fund folios as well as people trading online. And that has given a lot of vibrancy in the market. And we've seen this is a year where the market breadth, right? Contrary to what happened globally, like if you look at in the US, the market's been driven by only, say, a handful of the technology stocks. But India is a market where the breadth was unusually large in this calendar year, if you look at it, right? And we've seen the mid-cap, small-cap indices do fantastic in this calendar year. And that's the power of the retail money which has come in. I think, arguably, I mean, retail money, when it chases, it also chases momentum and prices. But I think fundamentally, I think what has happened in, I think I would say, amidst all the global uncertainty and turmoil what we saw last year, I think India has probably matured in that sense, not only from a overall volatility in the market also, but from a macroeconomic stability. Right, I mean, this was a year where we've seen that various, I mean, globally we saw, right, interest rates, US climb up crazily, right? The sharpest increase we have seen in many decades. And in India, I think our policy makers have been slightly much more responsive. They have been looking at what's happening globally, the domestic situation, and the response from the policymakers has also been very, very measured in that sense. And I think we haven't seen that amount of, while rates have gone up, it's been kind of a measure. It's not really impacted growth. So I think while globally everybody is worried about growth concerns, right, growth slowing down, I think India, we are riding on, right, still, because the latest GDP number which came in, again at around 7.6%, again surprise. So actually, this is a year we've been surprised on growth on the positive side. I remember at the beginning of the calendar year when we were looking at our numbers, okay, everybody was talking about GDP growth of around say 6% or even below that actually. So I think in that sense, I think India, both in terms of its growth outlook, in terms of macroeconomic stability, and also in terms of the whole retail participation, has been a great year, I would say.
Exactly. Could there be, Mahesh, could there be positive surprises in 2024? Because, for example, Q2 earnings, to the surprise of many people, came in almost in line or slightly better than estimated as a headline number 2. Everybody's penciling in for a US growth downtick. Maybe India and global growth also following suit, maybe earnings also following suit, GDP growth following suit. Do you believe that there is an outside chance that, hey, we might get surprises there too?
Yeah, so actually if you look at in the last 2 years, right, and the market has only scaled up now to recent highs, right? In that period, the market has consolidated in that sense, right? From September 21, right, when it peaked out earlier. And in that interim period, earnings have grown fairly strong. So the market, which was kind of expensive, right, that was around 2 years back, is now at a fair zone, right? Because earnings have caught up and markets, especially the Nifty, I mean, the mid cap and small cap might be a different story. So I think going forward from here, I think the earnings outlook, while next year, I think we have to wait and see how the world reacts, right? Because there is a fear about US growth slowing down, and some of the external trade will get impacted. But I think if we are now in a period where we are also going for elections, right? So once that is through, I think you will get a lot of, what you have seen is up till now is still the animal spirits have not yet come in, right, in the markets. Because while overall economy has been growing, the private sector capex, the investment cycle hasn't picked up. And there are a lot of ingredients are in place, right? Corporate balance sheets had delevered, right? So they are in a good shape to invest. Domestic demand is picking up, and the banking sector also is in a good shape, right? In terms of very well capitalized. I think that confidence, I think, will come in once the elections are, and that could be the new leg of growth, okay, which could there for the economy, where the investment cycle also picks up. Currently, it's been more driven by the government capex, and I think that would give a good stable visibility for long-term sustainable earnings growth, I think. And if that is the case, then there's no reason why the markets stood. As people talk about markets have reached a new high, but they'll always, right, if the outlook. So I think next year, calendar year, is where you will see a lot of the concerns which were there. When last year it was markets climbing the wall of worry, right? Your interest rates hike, inflation, geopolitical risks which were there. I think next year, I think a lot of these things will be behind us. Right? Yeah. Already inflation and interest rate concerns are behind us, and we've seen some kind of a risk on currently. But I think for India, I think you could see markets can actually surprise you much more, right, when all of these things fall in place. I think keep your fingers crossed, and there's some uncertainty in the first 1 or 2 quarters, I think, in terms of how the global growth and election results. But I think you could, markets tend to surprise you. And in fact, on earnings, I would say, in the last 2-3 years, markets have actually surprised. I mean, the corporates, I would say, not the markets, but the corporates have surprised. Because I remember prior to that, 5-6 years, we used to every way start with the earnings, and there used to be downgrades to earnings, right? We haven't seen that much, and that's I think again shows that things are looking better.
Well, aapke muh mein ghee shakkar, as they say, or whatever else. Maybe you want red wine, so be it. Bala, come in. It's an important point that Mahesh makes about how corporate India's resilience at every adversity that may have been thrown up as a basket has stood out really well. Could it be that we might end up seeing 2024 or maybe calendar year 25, and 2024 could be a start of that or a harbinger of that, wherein India Inc. doesn't just, let's say, climb walls of worries that may be the case. Maybe private capex is not there, maybe export demand is not there, but they actually surprise positively by virtue of all the measures that corporates are taken. We saw that during COVID. Everybody thought they'll be bombed out, and they came back. We've seen that in the last 2 years as well. Can there be a positive inflection point starting 2024?
I think as Mahesh mentioned, my view is we are in a sweet spot as a country. The initial pickup that we saw in the spending came from public sector. The last 1 year, we have seen pickup in private sector capex. Then more and more companies are setting up, increasing their capacity in India. Therefore, now private capex is just beginning to pick up. I think if you look at the gross capital formation in the country, have been rising. Second biggest stuff that happened on the base of Make in India theme, Make India is more manufacturing center, we have seen a significant drop in the import component. So that's something that reflects on current account deficit, balance of payment has improved. The import substitute, which used to be one of the worry in the past, so now has become how do you actually reduce the import in order to ensure the savior currency. Now we have seen a significant element of import substitutes that come from through the domestic manufacturing. And third, I think in my view, is if we are on a sweet spot. Most of the companies, despite in the last few years, have remained all the challenges we would have seen, and the thing what he mentioned about earnings upgrades have been happening, companies have been generating more profits, the balance sheets have become debt less heavy. So you don't have much debt in the portfolios, the leverage, whenever they want to build a business, can easily leverage and still go for expansion. Despite that doing that, the overall debt coverage ratio will remain at the tolerable level. This, in my view, is a great strength of Indian companies as well as in the Indian economy. And last but not the least, today the tax collection efficiency in India is one of the best. I think just the beginning of success that we are seeing. It can only keep getting better as we move forward, because an increased compliance that we are seeing, as well as GST collections concerns, as well as the direct tax collection concerns, we have seen a significant improvement. I think all around, if you see, there is one side the financial numbers are getting better, fiscal situation is getting better, currency stability is coming in from the macro point of view. Interest rates, despite is being hiked, interest rates remain relatively in a stable scenario without pushing up the cost of capital for companies. And last is actually money is available in the form of equity for companies to fund their growth plan. So these are all good combinations that to have. I think these things, fundamentals are in place. And many of the moving parts, which are drivers of the economy, earlier it used to be service sectors, which gave an initial flip after the COVID. Now the entire core sector, I think the beauty of the 7.6% GDP does not come from the service sector, does not come from the agriculture sector. It will come from the core sector, which has been one of the ambition for India for a very long period of time. When will the manufacturing sector will start contributing to overall growth? The core sector contribution, which has now been reflecting in the GDP growth, this in my view is the beginning of core sector contribution to overall economic growth. So this in my view, I think as we move forward, will not only of course bring in a greater element of conviction on Indian market, will also actually make the Indian economy to sustain the growth momentum for a long period of time. As long as we are able to see the sustainability of growth for at least about for the next decade or so, then naturally all things have to fall in place. Whether it is a flow of funds from overseas, whether it is domestic savings coming into the market, whether it is companies that are able to get the benefit of both the pickup in the spending as well as on investment. I think both will happen as a result of that. I think that's why I'm mentioning about we are at a sweet spot from that angle, and which in my view we would probably reap the benefit of this, not just only 1 year of 2024, even beyond that.
Yeah. Cross fingers for all of that. Gentlemen, stay on, so much more to talk about. Well, viewers, in this segment, we have established that the two gentlemen believe that 2024, we are in a sweet spot. If anything, there might be positive surprises as well. Who knows? And not a surprise necessarily, but just positive delivery, which might be anticipated. We'll slip into a very quick break, come back, and try and talk about how should you as a mutual fund investor, therefore, approach this optimism that is being exhibited on the show currently. Stay tuned.
Success for me is unwavering confidence in. When things are all favorable to you, you can't say, oh, I'm successful. Half the health you spend in gaining the wealth, and half the wealth you spend to gain back the health, which doesn't happen.
Back with the Mutual Fund Show right here on NDTV Profit, in conversation with the think tank at Aditya Birla AMC. And Mahesh, let me start this segment with you. Trying to understand how should an investor approach this optimism that both of you are exhibiting. Now, what is it that an average mutual fund investor should do aside of what she or he is already doing, because they are continuing with their SIPs, they are the true champions of the last 12 to 24 months. What are the cautionary things that people should keep in mind, and what are the things that they should do afresh aside of what they're already doing?
Yeah. So I think while we are saying that the outlook, okay, in the next calendar year should be reasonably fine, I think the risk reward, if you look at across asset classes, are fairly well balanced, right? I mean, it's not like equity is going to give outsized return. What we're saying is that market is fairly priced. Your earnings growth should be somewhere near the long-term average. I mean, last 2-3 years we had fantastic earnings growth, but I think that should normalize. And interest rates also are kind of elevated, and we expect rates to remain higher, right, for the next calendar year. I mean, we don't expect, at least in India, any kind of a rate cut. So even, say, fixed income remains a reasonably good asset class to look at. Gold also, right, if you look at, right, as a kind of a hedge, okay, against any other geopolitical and otherwise should be. So I think the risk returns across asset classes are fairly well balanced. So in that scenario, I think while to tide the market volatility, I mean, SIP is the best way, because that has allowed investors to actually participate in the market. Otherwise, people have been worrying, right? There could be a market correction, and a lot of investors I know who are waiting for a correction, and the markets have always tend to surprise. So those investors, I think they're able to participate in the market in the ups and lows and stay invested. So I think long term, I mean, equity still looks fantastic, I think. But I think I would suggest that a right asset allocation at this point in time across asset classes, I think would be a good way to tide the volatility, right?
So you're saying a multi-asset fund?
A multi-asset fund, okay, it makes a lot of sense, because, as I said, no particular asset class looks extremely undervalued, right, or which can give disproportionate or overvalued in that sense. So that, I think, would be a good option for investors to take care of that, because that will enable them to, especially for retail investors, right, the people, the new generation, they want excitement, right, and that kind of high returns, which we have seen in the past. I think don't expect that, and that's a caution I would like to expect, that don't expect those kind of returns what we saw, right, post-COVID. And people have got used to around 25% kind of a 20 or 30% return. I think that needs to be moderated down, and focus on your asset allocation through multi-asset fund or the hybrid fund. I think that should give you reasonably good returns with lower volatility.
Okay, so that's the central message. Exercise a bit of caution as well while the optimism stays. Bala, you guys have come out with some very timely, innovative products as well. I remember the conversation that we had with Mahesh and one of your analysts back in Jan 2022, talking about why autos could do well, and some thematic funds that you gave out at the right time, the treasury funds that you guys also came out with. To your mind, I'm presuming that this is the house view that you should take exposure to all assets. What are the things that you would reckon people should keep in mind when they are allocating to either large cap, mid cap, small cap funds, or multi-asset funds, or certain thematic funds?
Yeah. I think interestingly, Niraj, if you look at the customer segmentations, you have still many people who are not invested in mutual funds. I think there's only about 4 crores customers. In our case, we have about 50 lakh unique customers that we have.
So you're saying people should start investing?
People should start investing. I think if we divide them into 3 different kind of characteristics. One is conservative investors, moderate investors, and aggressive investors. And conservative investors are the one who actually sitting in the fence asking, what should I do? That means they have to start somewhere. I think the starting point when it comes to the question of mutual funds, to start investing for longer term, there are funds like Balance Advantage Fund, like multi-asset allocation fund, which invest in all the 4 asset classes, which includes equity, fixed income, gold, and silver, and REIT and InvIT. So that's the way I think these asset classes are there. That should become part of the core portfolio for the conservative investors. Then comes the moderate risk investors. For them also, they have to create a core portfolios and then look at other portfolios. For such investors, you have established 25 years of track record, 30 years of track record. It comes in the large cap focused funds, such as Frontline Equity or Sun Life Equity, which is a flexi cap fund. Such funds comes in. So that becomes actually part of your core investment, and when it comes to the question of moderate risky investors. Somebody actually, they always look for alpha, and for such investors, they are willing to take a risk. So then it comes actually the funds which comes in thematic category, and also small cap fund. When in case a thematic category, there are funds which are thematic in nature, but they have the longer term sustainability of such theme is very, very high, such as the digital India fund. So digital India fund technology is going to remain as a core parts of the heavy economy, moving parts of the heavy economy. Whether it is today or tomorrow is going to remain. So the digital India fund actually provides a great opportunity for people to participate who are looking for an alpha. Like banking and financial services fund is very focused only on certain segment of the market. Like Gen X fund is of course a consumption driven theme. Can also come as part of longer term wealth creation. It is a permanent theme, but it's thematic in nature, which you can call it as a thematic in nature, or it can be different kind of funds in style, but such kind of funds. Smaller mid cap is something, given the fact that Indian economy is actually at $4 trillion, going to about 5, and then beyond that it will go to about 10. Then naturally the breadth in the market have to widen. So if you have a longer term time horizons, 5 to 7 years period, despite all the whatever the view that could come, it's a costly and run up quite a lot, returns have been very, very high. But then if you take a view of say 7 years period, you must have some allocation in the segment, especially for those investors who are looking for alpha. In our case, of course, smaller mid cap like pure value fund. So that's why we have positioned each of these schemes, bucketing into the 3 categories, which can serve the purpose of considered investors' needs and moderate and aggressive investors' needs. Coming to your thematic, I think thematic is something that you mentioned about US. These are something which I think opportunity. Market always provide an opportunity, but may not be long-lasting in nature, but it provides an opportunity for certain window. Sure. The US investment opportunity that we identified, we did make investment overseas, when the yields are about 4.95, now it's about 4.45. Just imagine a scenario, the interest rates start dropping in 2024, naturally the bond yields will rally. As Mahesh mentioned about fixed income, also has a merit to have part of the portfolio. That's why we as a fund launched this opportunity investing in US govies. And that's something could also be seen for those people who have exposed all the investment to these 3 categories which I mentioned about it.
Yeah, sure.
And this is considered as on top of that.
Got it. Okay, just one quick follow-up there. Usually there's some data that usually when mid caps and small caps have such a large outperformance over large caps, the next year large caps tend to outperform. So I agree, 5-year, 7-year view, mid caps, small caps could be great, but a very immediate, let's say for somebody who's looking at the next 12 months from this to the next year, would a bias towards large cap funds or flexi cap funds with a larger bias towards large caps be more preferable versus the mid funds? I
think in the order large cap now probably the next 1 year, given the fact that as you just rightly mentioned, the rest of the markets have run up so much. The large cap fund such as fund and equity or flexi cap funds such as Birla equity, or even the MAF which you mentioned about, as could be one potential asset class which invest in all the 4 asset classes, which is the multi-asset allocation fund, could be the right asset allocation at this point of time for the year 2024 to consider.
Got it.
Let me just add here, I think one segment, okay, which is still not really for retail investors, that a lot of money is lying in our bank savings, right? Okay, so the liquid options, right, which are the liquid funds on the mutual fund platform, I think it's a great way of parking because they offer similar kind of a liquidity, okay, in terms of risk also, okay, there is not a well diversified. So I think that's the option, okay, where you can, I mean, bank savings rates are still very low. They have not gone other rates, right? So you can really look at some of your savings, okay, not for long-term wealth creation, but for short-term needs can be looked at either into the liquid fund or a kind of arbitrage fund.
Yeah, so there are only 4 portfolios. Let's increase them, yes.
Yeah, the reason why one should look at this as an option, what Mahesh mentioned about liquid fund, though it's not a great recommendations from an asset allocation point of view. The liquid fund definitely gives you an opportunity to move money from your surplus money that you have in your bank account into the mutual funds liquid fund. Then post that money moving to the right asset classes become much easier.
Much easier, sure.
Yeah, it's more of an entry point that you must consider. That's the way actually you can actually come easy into the mutual fund, into the overall investment style.
Yeah, well, that's a pertinent point too. Let me wrap the show, Mahesh, with a final question to you, and which is for somebody who's been in investing for the last so many years and is now wanting to take a higher advantage of the optimism that we expressed at the start of the show. Open to taking risky bets, open to taking riskier relative to the safe bets, let me put it that way, open to taking thematic funds, so on and so forth. Where do you think the possibility of the strongest alpha creation lies over the next 12 to 24 months?
So I think within the diversified bucket, if you look at it, right, okay, but I think a flexi cap strategy, okay, which we talked about, okay, would make that should be the core of your portfolio, right? A large cap and a flexi cap, not really high risky, but somebody wants to really look at slightly high risk appetite, and as Bala mentioned, right, we can look at a large and mid cap, right, which gives you a good combination of large cap and mid cap. I think again within the whole diversified bucket. But really, if you want to go niche, really in some of these sectors, then I would say that sectors like, for example, the business cycle, okay, is one of the sectors, okay, which is a thematic, okay, where you're playing the various cycles, right, in the market as well as the businesses. And we've seen a lot of sector rotation happen, right? I mean, 2 years back, it was the IT sector which did well, right? I mean, this year we have seen the capital good, the auto sector do well. So if you want to play those various cycles, so business cycle can be a great fund to look at. As a contrarian theme, right, digital India, as Bala mentioned, right, that can be a theme because while currently like seeing a slowdown in the US, but I think the spend on digital and globally is going to be much more. I mean, the whole move towards digital and cloud migration is still only 40% down,
exactly.
Right? So that'll play out over the next 4 or 5 years. So that can be a slightly contra kind of this thing at this point in time, which say the next 2 years, I think that can potentially give you a better alpha.
Great. Well, I can go on and on, but this is about the time that we have on the show. But gentlemen, thank you so much. It's special to have both of you in our studios during our launch period. So much appreciate you taking the time out. And to you and your teams and families, have a great year-ender and a superb 2024.
Thank you, Niraj.
And viewers, thanks for tuning in to yet another special episode of the Mutual Fund Show on NDTV Profit.